Good morning. Welcome to Good to Know Talk series, where our focus here is to provide financial strategies and grow your business and save on taxes. We understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. As always, we have James Kaw on the line. James is a financial advisor at Edward Jones. He works with small businesses, individuals, and families to identify their risk and develop strategies to help them reach their goals. And he's my trusted source in the industry. Good morning, James.
Hey, Janine, how are you?
I'm good. I'm good. Yeah, we are continuing our series on real estate, and I'm excited to have a guest with us that I'll let you introduce.
Yeah, absolutely. Today we have with us Darren Ogino. He's the president of Smart Money, and he's going to go over different aspects of, the borrowing, when looking to either buy as a primary residence and also an investment scenario. And these are some items that I wish I would have been better versed at the time when I purchased my condo. So hopefully, I'm very confident that he can add some value in this conversation. But he's been in the residential mortgage industry for over 14 years and just celebrated his 10-year anniversary owning Smart Money Inc. Smart Money is locally owned and operated, and Darren is a local boy born and raised on Oahu. Another interesting fact about Darren, he's also part owners and co-owners of Village Bottle Shop, which is in Kaka'ako in Salt, and also Pint and Jigger on King Street. And then they just opened up a new speakeasy called Harry's Hardware. So very popular spots in town. So I encourage you to check out his spots. But Darren, are you there? You may need to unmute. Okay.
Yep, I'm here.
Okay.
Hey, Darren.
Yes. And yeah, Darren, we'll kind of hand the mic over to you, and then take it away.
Sure. Can you see the screen okay? The PowerPoint?
Mm-hmm.
Yes, we can.
Yep, we can.
Awesome. Well, first of all, I just want to thank Janine of Smart Tax and Business Solutions for having me on this show. And also James, he's my financial advisor and someone I trust. So thank you guys so much for having me on. I don't want to bore you guys too much with mortgage guidelines and the parts of the mortgage that people really don't care about. So it's going to be really high level, just kind of where the current state of the mortgage market is right now, things you should be looking out for, anticipating in the future. And I think most of the questions can be answered through Q&A, and it's not going to be too much as far as guidelines on what mortgage guidelines are right now. It's not going to be too much of that. So let me see. So first off, I kind of wanted to talk about the current environment. I mean, if you guys have been paying attention to the news or just watching TV or reading newspapers, I mean, it's pretty obvious that mortgage rates are higher today than they were a few years ago. However, they are historically low. Here's a chart showing the Freddie Mac rate from 1971 until present. And if you look at this gray chart or graph on the top, that's your 30-year fixed mortgage. It was really high in the 80s. I don't know how many people here were buying homes in the 80s, but if you were in the teens on your mortgage interest rate on your 30-year fix if you're buying something back then. And as you can see, they progressively have come down over the years. And right around here is where our subprime meltdown happened. And the government intervened and rates are where they are right now. So if you look at the pointer right here, this is where we are today. Historically, we are still very, very low, and we're not as low as we were maybe a year ago or 2 years ago. However, looking at the past, we are still in a very good position as far as interest rates go. Here's a little bit about the real estate side, median sales prices. As most of us know, living in Hawaii, the median sales price continues to increase. And this graph or chart right here shows, single family and condominium homes, compared to 1 year ago. And single family homes, median home price is $772,500, up 3.69% year over last year. And for condos, the median price is $423,000 on Oahu, and we're up close to 11%, change, which is a lot. So just by looking at this, you can tell that we're in a seller's market. Here's another infographic that just kind of shows the median sales price as of end of February for a single family home and for a condo. Closed sales for single family homes are down in numbers, but the only reason for that is because of low inventory, not because of a lack of demand. And as you can see, days on the market are down because of the high demand in the market. So why were rates so low a few years ago? A lot of people ask me, like, rates are really high right now. And I tell them, well, they're not really high. They're just not as low as they were 2 years ago. But I think the better question is, you have to understand why rates were very low a few years ago. The first thing that people need to know is that when you do a home loan, your loan gets packaged, with other people's mortgages and put into one block of investments called mortgage-backed securities. These mortgage-backed securities, are then sold in the secondary market or Wall Street to large investors primarily, and this is how the money keeps rotating into the market. After the subprime meltdown, the federal government stepped in, and they needed to figure out a way to spur the economy. And the backbone of the economy has always been home sales. So one of their first actions were to try to make home sales go up and try to get people encouraged to buy a home. And the way they did that was they had to figure out a way to lower mortgage rates, and that's exactly what they did. So the federal government stepped in, and instead of Wall Street buying these mortgage-backed securities, which included a bunch of home loans in them, the federal government said, we'll buy them, and we'll buy them at a lower price than anybody's ever bought them before, and basically created a fake demand or a fake environment to buy these mortgage-backed securities. And this is why, at one point rates got into the low threes because nobody on Wall Street was buying them. It was the federal government printing money and buying these home loans. And they call this quantitative easing, is when a central bank or a government steps in to create this fake or false environment or false demand, and which in turn decreases your interest rates. The second thing that affects interest rates are bonds, more importantly, the 10-year treasury. When investors invest into bonds, which is also mortgage-backed securities, they have to decide whether they want to buy a 10-year treasury or a mortgage-backed security. And each of these investments, deliver a yield or a rate of return, and the investor needs to figure out which is better for them. So the mortgage-backed security is very closely tied to the 10-year treasury. And I'll show you the next graph. You'll see how so, okay? So this is a U.S. Treasury bond, and you can buy the bond, and you'll get a 2.855% interest rate back on your money. And this is today, so this is today's pricing, and you'll get it back in 10 years, okay? Interest rate and the face value. And if you look at the 10-year treasury over the last, 40 years or 50 years, and that's the treasury to the left. And then if you look at the mortgage-backed securities to the right, you'll see that the graph looks almost the same. These are two different investments, but they look the same because they're competing investments on the market. So the point is that when the U.S. Treasury, the 10-year Treasury, starts to increase in rate, so will mortgage rates. So most people don't watch the mortgage-backed security. Most people watch the 10-year Treasury because it's a more commonly known index. And if this interest rate starts going up, then mortgage rates also start going up. So as you know, rates have gone up a little bit, and the reason why is that the federal government started slowing down their purchases of mortgage-backed securities. So when they slowed down the fake demand, then mortgage-backed securities were forced to be in a natural environment where Wall Street now had to participate to buy these investments. And because they're competing against the 10-year Treasury, they have to have higher rates to attract these investors. What can we expect in the next year or so? Obviously I don't have a crystal ball, but just looking at the trend and looking at what's happening in the world, if the economy continues to strengthen, we can expect interest rates to continue to go up. The federal government is expected to make 3 to 4 rate hikes to the overnight rate in 2018, and this rate hike, overnight rate, doesn't directly affect mortgage rates, but they do directly affect the rate that banks are able to borrow at. So it's a trickle-down effect to home equity line of credits, credit cards, personal loans. If the overnight rate goes up by a quarter, you can expect to see a lot of these rates go up by a quarter to mirror the overnight increase. Short-term rates don't directly affect mortgage rates, but through the trickle-down, mortgage rates will most likely go up because the reason for the Feds to increase the overnight rate is that the Feds are confident in the economy, that we're doing well. And if the economy is doing well, then it's most likely that the 10-year will start increasing, and then the mortgage rates will follow it. Most of the common questions I get, the most common question I get is, what are the rates now? And this is a super difficult one to answer, so my answer is always, it depends. There's the whole spectrum of rates to choose from, and everyone's situation is unique to themselves. So it's very, very hard to just answer a question like that. However, I am going to attempt to just give you a general idea of where interest rates are right now. So the main things that affect mortgage rates are the current market, your credit score, and the size of your down payment, or basically the equity that you put into the home when you initially buy it. So the more equity or the more down payment that you have in your property, then rates tend to be a little bit better because you are less of a you're less risky by having more skin in the game. So what I did was I put together a general scenario. For example, in this loan example, this person has a 740 credit score. They're willing to put 20% down. They're buying a single family home with 1 unit on it. It's going to be owner occupied, purchase transaction with a loan amount less than $679,150 on a 30-year fixed rate. So if you look over to the right here, this is what I was saying, where there's just not one rate that's available. There's an entire spectrum of rates that are available to you. What you need to do is discuss with your mortgage person what rate is best for you and at what cost. I've highlighted here in this right column under 45-day. This is your lock period. I'm not going to get too much into your lock period, but just know that the reason why it's 45 days is that a purchase transaction takes approximately 45 days to complete. And if you look across on this row right here, we're looking at the 4.5% because the 4.5% is closest to 100, which means that it's the rate that is closest to 0 points paid to the bank. So right now, if you have a 740 FICO, buying a single family home, 20% down, owner occupied on a purchase with a loan amount less than 679,150, you can expect to get around a 4.5% interest rate on a 30-year fix with 0 points. Okay. And then if your situation is you have a larger down payment, or if you have a worser credit score, then the rate could be better, it could be worse. So what programs can help me get the most for my money? Most of the programs that are gonna, help you get more for your money or give you some back are gonna be like the first-time home buyer programs, or programs that are created by the government. So first off, we have down payment assistance program, which is a city and county program, which if you put 5% down, then the city and county is willing to loan you $40,000 at 0% interest and amortize it over the next 20 years. This allows you to buy more home. However, these down payment assistance programs, it's based on how much money you make too. So if you're in an upper tier of income, you may not qualify for a down payment assistance. But this is great for first-time home buyers, people just trying to get into a home, and need that little break. The second one that's probably my favorite is a mortgage credit certificate. And this one allows a homeowner to take 20% of the interest paid on a mortgage annually and take that 20% and take it as a tax credit. Of course, talk to your tax advisor, Janine, to see if this would be a good program or if you can take the credit. But this program also requires a certain amount of income, and it depends on the size of the household. So it'd be very difficult until I speak to you to figure out if you qualify or not. Other programs that came out from Fannie Mae and Freddie Mac are Home Ready and Home Possible. These are not first-time home buyer programs. So you can have bought a home in the past, and these programs that came out basically offer you an incentive on interest rates if you qualify, also based on income and locale. So it depends on where you're trying to buy on Oahu. Lenders recently, there's a lot of talk about private mortgage insurance. So BPMI is borrower paid mortgage insurance and LPMI is lender paid mortgage insurance. I'm not going to go too much into what those are, but they are mortgage insurance. Anytime you put less than 20% down, you're going to pay private mortgage insurance. And there's a lot of talk about, I need to save 20% down before I buy something, and I don't want to pay private mortgage insurance. However, recently lenders have been using their volume as leverage with private mortgage insurance companies and have really gotten private mortgage insurance costs down. So the cost of BPMI and LPMI programs are a lot lower today than they were, 5 years ago. So if the last time you talked to a mortgage guy was like 5 years ago, then programs have gotten a lot better since. And then the last area are government loans. This includes VA or Veteran Affairs loans, FHA, Federal Housing Administration loans, as well as USDA loans. So the VA loan is the best loan possible. If you are an active duty member or former military, you need to look into this loan. If you qualify for it, it's the best loan that you can possibly get. FHA loans are meant for lower down payment, 3.5% down minimum. However, Hawaii is just filled with townhomes and condos, and there aren't too many homes that are FHA approved if you're trying to buy a condo or townhome. However, if you're buying a single family home, it's a great way to get into a home at 3.5% down. And the last one is USDA, which is the only other 100% consumer loan if you're non-military. And this one allows you to get into a home with 0 down. However, on Oahu, USDA kind of starts around Ewa Beach and wraps around the north and kind kind of ends right before Hui Manu in Kaneohe. But if you kind of have a general idea of where you want to live, then it'd be easy for us to kind of find the loan that's right for you. So another question I always get is, should I wait until prices to drop before I buy? And the real answer is nobody really knows. I mean, if we knew the answer and had a crystal ball, then we'd all be super, super rich and retired by now. But the best we can do is try to give you enough information so you're able to make informed decisions based on what you know today. I just wanted to kind of put together a loan scenario just so you can see like what the consequences are of waiting. And let's just say, you find a single family home you want to purchase today for $800,000. And remember the median price of a home is $772,000 today. And you have 20% down and your credit score is 740. And you're going to do a 30-year fixed rate mortgage at 0 points. So if you look to the left, there's a scenario for today's scenario at 4.5%, 30-year fixed, $800,000 purchase, 20% down. Your total monthly principal and interest, this doesn't include property tax and homeowners insurance, but your total monthly principal and interest is $3,242.79. Okay, and let's say you decide to wait, and prices drop because we have a mini recession or we have a pullback in the market, and prices on homes drop 5%, and then rates go up 1%, which is a real reality because they really could be 1% or more higher next year. The new value of that $800,000 home lost 5%, so it's $760,000 in value now. And let's just say you took that 160 that you were gonna put today and you put it down against your loan amount's a lot smaller. You're at 600,000 loan amount. So you're like, wow, like I saved 40 grand. Well, yes and no, right? Because if this is your forever home, if this is a home that you plan on being in long term, then you're not really going to save that money, because if you look on the bottom of that, your monthly payment's actually going to be higher, by waiting. And this is just, I'm being kind of aggressive at saying that a price drop of 5%, which it could happen, but in reality, I don't know if it'll be that large. I'm just being a little aggressive here. And let's just say it goes the other way, right? Like say prices continue to increase. If prices increase, and let's just say it increased by 2%. Remember, going back to the chart, the single family year over year increase was above 3%. It was closer to 4%, but I'm using a 2% increase. And let's just say interest rates go up by 1% in the same scenario. The value of the home is now $816,000. And the loan amount has also gone up, and you're going to need $163,000. So you're going to need $3 grand more than the $160 you originally had set aside for in today's scenario. And then your principal and interest payment goes up by a lot, by almost $450 a month just by waiting and just by increasing by 2%. Okay, so I felt I was a little conservative on the increase. Looking back at what it's been in the near past. So there's not, I don't have anything else. I just kind of wanted to give you an examples of where we are today and real scenarios that you can look at and compare to in the future. And that's all I have. Thank you very much.
Yeah, thanks, Darren. And yeah, I think for everyone that's listening that tuned in last week, with interest rates going up, especially in an investment real estate scenario, again, you have to revisit looking at real return versus nominal return, because if the annualized average increase for Oahu real estate is 4.84% since 1985, and interest rates go up to say 5.5%, which Darren said may happen, relatively soon, you got to look at, your investment return and look at the real return, not just at the nominal return. So I'll be honest in saying that I don't think Darren's trying to sell anyone on, buying a place, but right now interest rates, in my opinion, I don't have a crystal ball, are going to go up. and this is probably one of the times where I say, you know, the best time to buy is now, because interest rates most likely are going to go up, and then real estate property in Oahu for the most part is going up, you know. So no, thanks for that, Darren. Janine, did you want to add anything?
Well, we actually have a question from one of our listeners. He asks, how are rates affected with investment properties? Do businesses have credit scores? Is there a difference?
Well, yeah, I can answer the question. Well, there's two types, right? If you're saying investment properties, you can be an individual investor, and you know, interest rates are gonna be a little bit higher. So how banks determine interest rate is they usually start off with a base rate. Okay, so there's a rate that everyone qualifies for, and then they start adding in your risk. So if you're an investor, then you know. Lenders tend to think investors are a little bit more risky because they don't live in the home. They're not watching over the home on a daily basis. So they tend to build in that risk into the interest rate, and they may increase the cost of the rate or the rate itself, depending on if you're an investor or own an occupied property. I think part of the question asked about like if, you know, if a business were to buy a property, that is an investment property, but then that also changes the bucket from residential to now commercial. So even if you're buying a residential property, but your business is buying it, you're essentially turning the loan into a commercial loan because it's not an individual that's purchasing the home. And it really depends on the bank. Most banks, if you're trying to buy a home in an LLC or a business entity, you're going to pay commercial rates and commercial costs, which tend to be a lot higher. Commercial appraisals tend to be in the thousands versus in the hundreds on a residential side. So it kind of depends on your scenario, but commercial purchases will tend to be a little bit higher. Hope that answered your question.
Gotcha. Yeah, we're coming up on our time. So for those of you that had any more detailed or specific question, please reach out to Darren and his team at Smart Money Inc. I'm very confident that they could be a great resource to you. Any tax-related questions, obviously ask Janine. And then when it comes to either saving or considering investing in real estate, everyone can always contact me to get a second opinion as well. So Janine, did you have anything else to add?
No. Yeah, if there's any questions or you need to get in contact with Darren, you can also email us at info@smarttaxhawaii.com. Thank you so much, Darren, again, for your time and being with us.
Thank you. Thanks for having me.
Yeah, we look forward to next week, same time, same place, as we continue our series on real estate. Thank you for joining us and have a great week.
All right. Thanks, Janine. Thanks, Darren.